Hey, good morning, everybody. It is Hammer. Today is Tuesday, October 21st, 2025. I, of course, am here with your live mortgage rate update, talking about what else is going on this morning. Good morning, y'all. Again, my name is Hammer. I am the founder of Originator Success, Grab and Go Social, and Rate Sensei, amongst other things. So, although y'all kind of know me for the rate stuff, and that's Rate Sensei, we do have some amazing products to help you to get more business heading into 2026. So keep that in mind. Remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern time, except for yesterday when the internet broke. I saw this post on Facebook, so I can't take full credit for it, but it's kind of funny that the government's been shut down for 3 weeks and we feel it. But do we really feel it? However, Venmo, the AWS servers, the Amazon web servers get shut down for one day, and it brings us to a crushing halt. I know many of you were affected by it. Let me know in the comments, were you affected by the AWS outage? You'll notice in the text that I sent out there that I was going live. And for those of you that don't get that text, why not? We send out a reminder text every morning when I go live, hmmr.io/reminder, or use this cool QR code over here. And don't use your text for any nefarious reasons. We don't sell your information. We just send out the text to let you know that we're going live so you don't miss anything. It's also good in case I do run into problems where I can't send out where I can't do a live and I can send out a text. So make sure you sign up for that. But anyway, it affected so many things, having that outage. It was pretty crazy. So it's kind of funny how much that affected things. But anyway, today we are going to be talking about, and I'll put it up on the bottom of the screen. We're going to talk about what the technical indicators are telling us. I'm going to go a little bit deeper in the technicals today than normal. There's a lot there to unpack. So we're going to spend some time there. We're going to talk a little bit about the CPI data that's coming out at the end of the week and what effect that might have on rates. We're not going to go too deep on that one because it's still a little early. We got some time. And then we're going to talk about the 10-year Treasury yield. That is a big one. Again, it's kind of part of that technical conversation, but it's an important one. We're going to go there for sure. So anyway, if you're here this morning, say good morning. Remember, you can join me live 9:30 a.m. Eastern time. If you're watching on the replay, do me a favor. All I ask, just give me hashtag replay in the comments. Let me know that you are here. That helps me to kind of see how many people really do go back and watch this later. So if you are here, say good morning. Let's say hi to the live folks, and then we'll jump into the rest of it. We got Mr. Randy Tico. Giddy up, sir. He was the first one on this morning. Good morning, sir. Great to have you here. Thank you for joining me, Mr. Tico, as you do so often, each and every day. Matt Rasner, good morning. Deb Dickinson, great to have you here. Michael Love, Brandy Brickler, good morning. Kenny Rivard, Megan Bissell, thank you for joining. Mallory Fotiadis, good morning. Anthony Kufi, great to see you. Did I get that right? Kufi? That's how I would pronounce it. Is it Kufi or Kufi? Let me know in the comments. Ooh with an O-O, ooh, or with a U, U-H. So let me know in the comments. I'm curious. Angela Walters, good morning. Vicky McSweeney. I see a lot of you coming in on YouTube now, which is pretty cool. My website service rocks. Thank you, sir. Are you a Originator Success member? I did not know if you were, but thank you. Thank you so much. Mike Morano, good morning. Arrive crashed. Yeah, and again, that's not on them. Don't get mad. Poor Arrive. So many of us use external servers, we don't keep server farms. So, by the way, exciting aside, today, look at this. We've got full on, I'm going to turn off the fancy camera things. We have full on lighting, y'all. Do you know what that means? Do you know why those lights are lit up? That's right. I got electric, baby. We got electric to the barn. I am excited. I know that seems like a little thing. I've been running on a generator, which means running just a few items. This will allow me to go ahead and really move forward, getting everything finished, putting in the split units. So we've got heating and cooling. We'll get this place painted up and decorated and looking pretty. You guys will be here for the journey. I'll tell you, though, this also gives me a space to work, and it's amazing how much your environment affects your brain, right? I'm sure many of you know what I'm talking about with that one. So, yeah, Mallory, you had issues with operating systems and locking loans. Well, the good news is If you didn't get to lock anything, that's okay because rate sheets are going to be better today. So let's go ahead. Let's jump into that one first. Mr. Siegel said today is National Pumpkin Cheesecake Day. Anything in the fall seems to have pumpkin in it. All right. Pumpkin pie or pumpkin cheesecake? That is the question of the day. I'm throwing that one on there. Pumpkin pie or pumpkin cheesecake? Pumpkin pie or pumpkin cheesecake? I mean, I'm okay with cheesecake. I'm not a huge cheesecake lover. To me, it's not all about pumpkin cheesecake. So I'm going classic pumpkin pie. Classic pumpkin pie trumps pumpkin cheesecake. Let me know what you think in the comments. While you're doing that, I'm going to go ahead and we'll get to what's going on in the markets and all that stuff. And you know how it goes. So, all right. So let me just move Ron's comments. Sorry, Ron, we're going to move your comments. And thank you for that, though. Ron said today is your office workday officially begins with my daily live, said Mr. Tinkle. Thank you, Randy. I appreciate that, man. That is awesome. I'm glad that you shared that with me. I'm getting here to the comments. All right, there we go. So let's go ahead. Let me pull up Presentify real quick. There you are. All right. Let's go with yellow. It's a little easier to see on the screen. So what I want to show you this morning is to start the day anyway, mortgage-backed securities currently up 6 basis points. And I want you to see, I'm going to use the arrow. It'll give us a little bit of a cleaner line here as I draw this. So don't worry about the actual arrow itself. I want you to see the line. What I'm pointing to is the line here. Now, this goes all the way back. You'll see here, it goes back till April. Which you can see it's got my name over it, but that's April right down here. Okay. So all the way back in April, look at where mortgage-backed securities, the lowest point we hit this year was in May. And if you kind of take that and look at that to rate sheets, you'll see that it's the same thing. Rates were at their highest point in May. I like purple for this one. So rates were at their highest point in May. Over 7%, you can see here, coordinates, right? And that's going to match up with what we see here with mortgage-backed securities were at their lowest level. Remember, when mortgage-backed securities are green and going up, they're going up in price, what they're selling for. And that means this is good. That means better pricing, better rates. All right. That's our takeaway here. So from May to where we are now, I mean, look at this. It's, obviously it's not a straight road. You've got ups and downs as we go through this one. It peaks and then it drops, and we can go back and look at these dates and see why these things happen, right? But we got peaks and drops and peaks and drops and a big jump, and then you see it take this path. And it goes up and then it comes back down. Now, again, the green oversimplifies, but look at how we've seen rates improve through the year. And hopefully that gives you a little bit of some happy vibes and some happy feelings and all that good stuff. Now, let me just pull this off. I'm going to bring the window over so it matches up next to my goofy head here. And let me bring the bottom up. Just bear with me. All right. So I wanted to show you, number one, mortgage-backed securities, mortgage bond pricing. That is the ultimate of what we want to be looking at as far as where rates are at, right? Now, this 101.28, we hit this 2 other times. You'll see it here and here. And it was like 101.29. Same thing, right? Same thing. So we've hit this twice before. But otherwise, as we go through, it has been a long time since we've seen it here. Now, I'm going to go ahead and let me, so if we, not a perfect line, but if I take my time here and give you that line, we want to watch and see what's going to happen. This is one of those situations right here that we want to be paying attention to, because one of 2 things is going to happen. When we look at the technicals, if mortgage bonds continue to improve through that line that's breaking through that resistance, it will then act as a technical support level, and we could see rates continue to improve. As far as how far they're going to improve, though, right now, rates are generally, let's call it that they're right here, they show at 6.22. However, what I want to point out to you is right here, the last time that we saw this level, September 15th, the next day, September 16th, rates were at 6.13 according to Mortgage News Daily. But look at that. We went from 6.25 down to 6.13. Right now, if we look at where we were at like 6.323, 6.23, 6.22. This morning, we should see another pretty good drop down. It should bring us down there. Now, unfortunately, though, we only lasted one day, if you remember, because boom, it popped back up. But what happened? Let's test your memory. What happened on September 17th that we saw this nice drop, but then we immediately saw a pop up? Who put it in the comments? Let me know what was happening on September 17th that's different than what we're seeing this time for now. Let me know in the comments if you guys remember what happened. The other thing that I want to show you that's different this time, and then we'll go back to that. Hello, George. If I get distracted, it's because George, come here. Come here. What are you doing? Hi. He's in my face. You going to get up on the microphone? Say hi to everybody, Mr. George. Say hi. Look at those eyes. He's a pretty boy. All right. So anyway, George, you sit on my lap and let me type. So as we take a look at what we got going on here, I wanted to show you this. This is the other big difference. This time around, we're at 3.95. You'll notice that is the lowest that we have seen this 10-year treasury yield. George, stop pushing up the microphone, dude. You can't eat the microphone. This has been the lowest that we have seen the 10-year treasury yield. I'd have to go back and see if it's for the year, but I believe for the year. In September, it was still above the 4% mark, right about here, okay? So in September, we were still above that 4% mark, whereas now, take a look at what we're at now, we're lower. This is opening the door. So, and that's right, Brandy's got it, Fed meeting. The Fed meeting is what was different last time around. That is why you're there. Amber wants to know, can I explain a technical support level? Yes. So what happens when you're looking at these fancy Japanese candlesticks? Let me clear the Presentify for you. Whenever you're looking at these Japanese candlesticks, and let me make this full screen. Let me get my head out of the way for a minute. All right. So making this full screen, and let me just pop your comments out. So when we look at this, there's certain patterns that we see. So these are called the technicals. That's the first thing. So when we talk about a technical support or technical resistance level, it applies to these candlesticks and the trading. Now, remember, a green candlestick is a positive. The body is the fat part right here, and the top of the body right here. This fat part is called the body. This thin part at the top is called the wick. And if it's on the bottom, like here, it's called the tail. Now, this is a good one right here. If we just look at this candlestick right here, we'll talk about that one. So when it's green, it means we started the day here. This was the lowest point that bonds traded at in the day. That is the tail. When it's thin, it means they didn't end the day that way. So we came down this far. We pushed up. They went up as far as the wick goes, but they came back and ended the day where the body is. The body is where we started. I'm just going to put an S, and where we ended the day. That's the beginning. Now, if it's red, it just means that we started at the higher level. We lost ground and closed at the lower level. So a green candlestick, we start low, we increase and improve, and we end higher. That's good for pricing. A red candlestick is bad for pricing. Now, what happens is you have different levels. So the different lines are what we call moving averages. These are levels. If you are trading above it, so right now, these mortgage bonds are trading above this blue line. The blue line is the 25-day moving average. This is arguably a technical support level, meaning that if bonds come down like they did here in this section right here, let me get rid of that for a minute, that they will come down, they will test this level and then come back above it. Now, do you see this day right, this grouping right here? See how all of those wicks, they came above the blue line, but then we ended below it. Came above the blue line, ended below it. Above. When we want this one, if positive is up, and the reason I point this out is the 10-year is reverse, okay? But if we want to go up, if we're below it and we're pushing up against it and we're kind of smacking our head on it, that's a resistance level. It's resisting bonds to break through it. If we are above that level, if we lose ground and we come down, you would argue that we will bounce off of that level and it would go instead, you lose ground down, and then when you hit it, you will bounce off of it and it will act as a support level. It will give you support. So right now, when we look at the fact that previously, these are previous highs, and it means that for whatever reason, traders, when we look back 6 months and we look back a year even, you will see, look at how this was a level right here. We were nowhere near it anywhere other time in the past. And we came up against it, especially, let me go back 6 months, a little easier to see it. Look at this huge increase. So this is a rally. This is a huge rally in bonds. Bonds rallied and traders said, okay, but it hit that level and they said, that's enough. That's enough. And we don't think that we want to spend more than 101.28 to get this bond at that point. And then it falls down and it tests it again. And once again, they said, nope, we're not going to do it. And you could see there's a candlestick right here. And let's change it to 3 month. You could see the wick right here. And you see this wick here and this wick here. They're testing that same level. And when you see these wicks, these thin lines, it shows you that for whatever reason, bond traders were not willing to pay more than 101.28 and push bonds higher. Now, that's why it's above us. It's a resistance level, and it is proven in the past to be a level that bond traders were not willing to go above. They wouldn't pay more than 101.28 for the 5.5 coupon. Now, what we're hoping to see is that improves. If it does, that's going to open the door for better rates and better pricing. One of the reasons we can have hope that's different is the 10-year treasury yield. So it is a big deal that the 10-year treasury yield is below 4%. The previous times in September when we saw mortgage-backed securities drop down to that level, the 10-year treasury yield was not below 4%. That is a huge support or a resistance level. Remember, the 10-year yield, we want that to go down. So that is a resistance level. That 4% mark is a resistance level. The fact that the 10-year is below it and closing below it and maintains below it, and at 3.95, that's 5 bips. That's a big deal because we're not at 3.99, right? It's 5 basis points lower. What this is showing us is that traders are willing to buy the 10-year even at a yield below 4%. And oftentimes that means that mortgage-backed securities can also improve and break through that technical level. So we're watching the technicals closely. And if you look over here, you'll see that even though we see, little movements down and then it recovers and it comes up higher on the day, little movement down comes up higher on the day, kind of flat. And then we're improving and we're improving. Overall, we've got a nice kind of curve to this, again, not a perfect line. There's areas that it's above it. There's areas that it's below it, but we are moving in the right direction. Now, what does that equate to and what's driving it? Well, it's all about where they're going to put their money and why. So we look at inflation, and that's why the inflation data is going to come later this week. And let me throw the, thank you, Randy. Randy said, great education. Austin should use this to provide content. Thanks, man. Ceiling of resistance, floor of support. Yeah, sometimes I say it backwards. Mike, did I say it backwards? And awesome. By the way, kudos to Amber. Thank you for asking, because we have curse of knowledge, right? And I've explained this stuff before, but I don't know if everybody that's watching today had seen that in the past. So thank you for, saying, hey, tell me more about this. Guys, that's what we're here for. I mean, I do this just because I love y'all, right? So if there's something I can clarify or improve, let me know. I want to make sure we get through that. So anyway, as we kind of get through this part, bear with me. I'm just changing the advice to the bottom. So this puts us in a position when we're trying to forecast what's going to happen with rates, right? Right now, we see rate sheets that are improving. And we've seen rate sheets that have improved. If we kind of pull this even, look at this, right? So we went through a period of time coming through September and into early October where rates really weren't moving much. I mean, this is pretty, this is, look at this is 6.3, this is 6.35. You're not even within an eighth of a point in rate where we're seeing pricing move. Pricing didn't even move much at the end of September and October. Then we have seen, I'm going to use green because green is good and we associate that with better rates, right? Then we see this nice drop lower. And what we're looking at is where we are, like this is 6.2. Let me pull this back just a hair, see if we can't open this up a little bit. Okay, so this morning, we should see this coming down near the same level. Now, if you remember, though, I was surprised that we dropped this V right here. I was really surprised when we saw this first drop. And we may not see that today. They may be hesitant. But if you equate where mortgage-backed securities were and where lenders were pricing. But that's not the only variable. Lenders may price more or less aggressively depending on where they think things are going to go next, how their volume is, what's already locked. So, but there's plenty of reason to see this go ahead and improve. This morning, if we do get back down and we match this level, I would love to know. I'm going to ask you guys tomorrow. So run some scenarios for me. I want to know if rate sheets look like this. And we'll use Mortgage News Daily and we'll see what Matt Graham finds as well. But are we at this same level, question mark, right? Because that's where the mortgage-backed security pricing says lenders should be pricing. Are they pricing at that same level? And we'll find out. Now, we could continue to see rates move a little bit lower, but it's important to note this is something that if we see the 10-year lose steam and reverse, then that means that rates are not likely to move lower. In fact, they could creep a little bit higher and you'd want to consider locking. We want to float for now, but that's what we're looking at. We want to be watching that 10-year treasury yield. If it goes back above 4%. By the way, why are we spending so much time on the technicals today? There's no other what we call fundamentals. The fundamentals is the data and everything happening outside of the technicals that's influencing traders. Right. Well, we're 3 weeks into the government shutdown. There is no sign at all that it's going to be over. We've got the CPI inflation data coming out, but that's not until Friday. Today's only Tuesday. So we've got a few days that we're going to be watching and we want to see what's going on with these technicals. We're also looking to see what are markets pricing in for expectation for these Fed rate cuts, right? And right now an October cut, it's almost guaranteed. The Fed meets at the end of the month, and on the 29th, they're going to come out, and we think they're going to go ahead and cut rates. In December, markets are betting another rate cut, almost 100%. So the market's pricing in 2 cuts for this year. However, when it comes to mortgage rates, they're pricing in not just what's happening this month, what's happening even at the end of the year. We're also looking at January, March. Where do markets think that rates will, that all of this stuff will be in 6 months? Because think about it like this. If I said, I will give you $1 today, and that dollar will buy you a box of Mentos sour gum, or you could buy this gum in 6 months. Now the gum could be 50 cents, or it could be $1.50. Depends on what happens with your buying power of that dollar, right? Maybe that dollar is not enough money to buy this pack of gum in 6 months. Or maybe you could buy 2. And again, this is an oversimplification, but this is how it works. Or you could buy 2 packages of gum with that same dollar if you wait 6 months. That's what traders are doing. They're trying to figure out, do we want to invest in bonds now and lock in this rate of return? And again, oversimplification. I know it's much more complex than that, but this will help us all to understand it. Do we want to lock in this rate of return that we're getting right now because we think that rates are going to move lower over time because the economy gets weaker and the Fed will need to stimulate things? Will the Fed go for an aggressive rate, a neutral rate, or an accommodative rate? This is kind of their aggressive rate means they raise rates because they want to slow down the economy. And accommodative rate means they're lowering rates because they want to encourage businesses to invest, borrow, and hire. Okay. And a neutral rate means that we have a balance between that we are growing, the economy is doing well, inflation stays at or around 2%, but employment is also doing well. What we've seen are signs that employment is weakening. If those signs continue beyond what they currently are terming as an acceptable level, that would change things. So hopefully that gave you a lot today. Ron, so we have to talk about fat bodies before 7 a.m. But Siegel, you don't have a fat body anymore, so you're not allowed to even joke about it. I still have a fat body. So I'm definitely going to go there. We'll talk more about the inflation stuff tomorrow. Sean Segaloff didn't know if he was going to be on this morning. I didn't see his name. And he had a question about the fact that if the Bureau of Labor Statistics has been closed for 3 weeks, how accurate will this data be? And I haven't really read much on that. So that's a good question. I'll do a little research on that. But hopefully y'all found value with today. And again, thank you for joining me. Appreciate y'all. And hope all this stuff helped you. And we'll see what tomorrow brings. And pretty soon, hopefully, it brings some painted walls and some stained ceilings, and the TV will be set up and all that stuff. But as of right now, I'll just take a minute and turn off all these and pull off the charger. By the way, for those of you that sometimes wonder, this is my cell phone that I use as the camera. So that is the current layout. I'm going to put the TV up on the wall now that we've got power and juice. We could do that real soon. Now that I've got enough power, I was trying to run this. This is a HEPA vacuum. It's used for when I'm using like woodworking and stuff. So it doesn't get clogged. Because I still have a lot of wood dust, very fine wood dust on the floor and everything. But now that we've got everything on, we will start prettying it up, putting down some flooring, finishing it up here. Another time, I'll show you guys downstairs in the area down there. For now, though, we got George and Sophie. They're hanging out over here. Say hi, George. At their cat tree, they like to chill. And otherwise, when I sit on the couch and I work from the couch, they like to sit by me on the couch. I really do enjoy having them, my barn cats. So Ron Siegel said the BLS will be equally as accurate opened as they are closed. I don't disagree with you, my friend. Thanks, Mike. Appreciate you. And then, let's take a look. So who was the question of the day was pumpkin pie or pumpkin cheesecake? Let's go ahead and see your answers on that, and then we'll wrap up. So Ron Siegel, cheesecake. I love you, Ron. But again, yet another thing that we have to agree to disagree on. I'm going with the pie, baby. Pumpkin pie, Mike Tebow, my man, we got it. Leroy, thank you for the kind words. Appreciate you. Let's see who else we had and where we're at. So pumpkin pie, Allison Foy said. We got 2 for Team Pie. Deb Dickinson, 3 for Team Pie. Will Patterson, 4 for Team Pie. Team Pie kicking Cheesecake's butt, but Cheesecake coming in with Brandy Brickler. She's bringing in the cheesecake, but Anthony comes in with pie. Randy Tico, classic pumpkin pie all the way. Cheesecake is only strawberry or cherry. Yeah, I'm with you. Or even raspberry. Yasmin said, I'm glad you're back. Thank you, Yasmin. Appreciate you. Me too. And Angela's going cheesecake over the pie, but it does look like the pie has a clear win. Yasmin also coming in with cheesecake, though. So, but I'm going to have to give this one to the pie. Pie is the winner. Pumpkin pie. All right, y'all. But you got to have whipped cream. By the way, they make this really cool thing on Amazon where you can make your own whipped cream. Oh, so awesome. Got to get it. All right, y'all. Catch you later. See you tomorrow. And Amy Blaser loves pumpkin pie. Me too. So, all right. I'll catch you guys tomorrow. Take care, everybody. Bye-bye.